Hello, everyone. So today we are here to present our project, which is about predicting Bitcoin prices based on historical data and news sentiment. I am Shivani.
Hello, I'm Adam.
Diving into our project, let me first introduce what our problem statement is. So here we are addressing a crucial concern in cryptocurrency investment, which is the inherent risk. This risk is because of the high volatility, making investment decisions more challenging than stock markets. So what are we trying to achieve here is to support investors and traders in this unpredictable market by providing insights of the increase or decrease trend for each day based on news sentiment and historical Bitcoin market data like traded volume and prices. Since Bitcoin has the highest market cap, we are currently restricting the scope of this project to just Bitcoin. We would start off by presenting the results from our best performing model, which is the vector autoregressive model. So our training set is from 15th November 2015 to 28th October 2023, and we tested our model on days from 29th October 2023 to 11th November 2023. We were able to predict the trend as increase or decrease correctly 71% of the time during this period, as highlighted in the purple box. Since our data set was balanced, we chose to go ahead with accuracy as our metric. Just to clarify, though vector regressive model is a regression model, we just are trying to use the predictions from this model to calculate the trend, which is going to be increase or decrease, which is why we were able to convert it into a classification task. So we also wanted to show how this model could actually be put into use in practical application through a simple simulation. So imagine you are making an investment, or you made an investment of 100 BTC on 28th October 2023, and which is an equivalent of 4 million USD. So we used our model to predict the trend in Bitcoin prices and during our test period, and compared these predictions with the actual Bitcoin prices in USD values during the same period. So our graph shows our findings. So if you look at the blue line represents the values predicted by our model, and the orange line represents the actual values. So we use the values from the regression to indicate whether it's an increase or decrease compared to the previous day. As we can see, our model is actually being able to correctly capture the rise and fall of Bitcoin prices. As you can see in the first box that is highlighted, you can see there is an increasing trend which is being predicted by both our model and the actual trend that is observed. And again, if you can look at the second black box that is highlighted, there is a decreasing trend which is again being captured correctly by our model. But we would also like to point out that because with the model work accuracy was built based on the trend, we were able to achieve high accuracy. So currently the strength of the model is predicting trends, which can be used as a supporting tool for investors considering market dynamics. But there is still scope for improvement and expansion to using regression to actually predict the values.
All right, I'll go into the overview for the data set that we use to inform this project. As we mentioned before, we're using cryptocurrency, specifically Bitcoin historical price data, and we are also incorporating sentiment analysis data from the TDM Studio ProQuest sentiment analysis tool. This data set covers a period from November 15th, 2015 to November 11th, 2023. The features of this data include the dates, opening and closing prices, previous closing prices, the volume of Bitcoin that was traded, in addition to 9 distinct emotion scores that are assigned to various documents, including news articles, interviews, editorials, dissertations, and others that were all averaged on a weekly basis over the period of the entire data set to give them a specific emotion score. And this covers approximately 12,000 documents. So during our exploratory data analysis phase, looking into the combined data set with the Bitcoin price data and the news sentiment analysis, we came across this interesting visual that we have in front of you here, where we are showing the Bitcoin closing price over time, which is the faint gray line that you see in the background. And then we've overlaid the anger and happiness emotion scores over time as well, as these emotions are the most polar that we were able to view during our analysis phase. And what we can see, and what we'll explore in this slide here, is that during the period of October 2020, which those articles I had in the previous slide are an example pulled from the pool of articles that were analyzed. Right in the center, we see an enormous uptick in Bitcoin price in late 2020. And we can see that with that uptick, there is a strong correlation with the happiness score increasing and also a decrease in the anger score. So based on this observed correlation, we thought that this was a promising avenue to approach during our analysis and building our models. So just to discuss some of the pre-processing steps that we used in building our machine learning models, we checked for duplicate information within the data set, identified sparse features, of which there were none that we removed. We imputed missing data using the mean, and we also scaled most of our features using a standard scaler during the machine learning phase after we built the pipeline and put all of our models through this pipeline. Next slide, please. In addition, we also engineered several features with the data set, some of those being the actual trend for each day of trading. So what this is it represents the increase or decrease from the previous day's price of Bitcoin. And this is binary, 0 or 1, and that indicates the increase or decrease. We also included 7-day rolling averages for the sentiment, the trend, and the volume of Bitcoin traded, and the closing price. This was to help inform trends within the data set, that because the sentiment analysis was aggregated on a weekly basis. In addition, we also included some features that were all related to the previous element of the specific features, and we included those as well, so that way anytime that a model was doing a prediction on a particular day, it was doing it with data that would have been available for it from historic data.
Next here, we are going to talk a little about the models that we used in our approach. So first, we wanted to work on a baseline model, which was the dummy classifier, and this had an accuracy of about 50%. So, and then when we experimented with XGBoost models, we actually used two variations of XGBoost, one with fixed window cross-validation and the other with expanding window cross-validation. To explain a little bit more about what these are, so in the expanding window cross-validation, the model was initially trained on a small portion of the data and tested on a constant test size of about 2 days. And then we gradually expanded this window size and until we covered like almost the entire data set, and we had like 2 days to test. So the reason why we decided to go with this approach was we wanted to understand if extensive historical data actually improves predictions or not. And the second approach was fixed window cross-validation. So here, as the name suggests, we actually fixed the size of the training cells window, which was about 400 days. And the test was always the subsequent 100 days. So each time after we fit the model and got the predictions, we slid the window to by 100 observations. And we again continued this approach. So the reason why we wanted to check this was we wanted to see if the prices are being influenced by only the short-term changes in the market, or do they also or are they affected by the larger historical data? So as we can see, the accuracy using the accuracy metric, we can see that the performance with an expanding sliding window is slightly higher compared to fixed sliding window. So which reiterates our validates our experiment that historical data actually plays an important role in determining the prices. But among these models, the standard performer has been the vector autoregressive model, whose results we showed in the beginning. So the outcome has been about 71% accuracy. So this is an indication that the vector autoregressive model is more robust in capturing the complexities of financial markets. Let's understand a little more about this model. So this model dives into the emotional components of the Bitcoin market. It analyzes how sentiments like happiness and fear correlate with hard data like price fluctuations and trading volumes. So we use the happiness score, fear score, Bitcoin's traded, closing price difference from the previous day as our features in this model. And because we found from the previous visualization that Adam showed that there is a correlation between the sentiment scores and the prices, we found that there can be, when there is a spike in the happiness score, it can be an indicative of a significant price increase as well. So the emotions and the market metrics go hand in hand. So, but we also needed to come up with a value on how far behind we need to go with the data. So for this, we determined the optimal number of past days, which is called as the lag days, that gives us the most accurate forecast. Our research and through analysis indicated that looking back at 7 days worth of data is actually the optimal number. With this approach, we forecast future Bitcoin prices by analyzing the intertwined patterns of past sentiments and market behaviors. To elaborate a little more about how we came up with this 7 lag day feature value, we performed the AIC test, which is typically used along with vector autoregressive models to understand what is the optimal lag days to be used. So this evaluates the model fit across multiple lag days from 0 to 7, and then denotes which one would be optimal. So generally, ideally, the day which has the least AIC score is considered to be the one which is most optimal. In our case, we can see that lag 7 had the least AIC score. So we decided to go ahead with this. We are also showing here a snapshot of our model regression scores results. So the target variable here is the closing difference. By closing difference, we refer to how much do we expect the price of Bitcoin to change compared to the previous day's price. And the dependent variables here, if you have to interpret them, they indicate if you change the dependent variable by 1 unit, how much do they affect the closing price for the day we predict. So the prefixes that you can see before the variables indicate the number of days lag. If you look at the first red box that is highlighted, we can see that 1 unit change in 1 day lag of closing price difference is associated with 0.05 Bitcoin decrease in the closing price difference, holding other factors constant for the current day. And also at the 5% level, we can see that the closing price difference at lag days 1, 3, and 6 are significant, indicating that these are most important when you're trying to predict the current day's closing difference.
All right, and so going back to talking about the value to users that the results from our project indicate. So we spoke before that the pain within this particular subject area is losses that investors incur based on speculation in Bitcoin. So the models we have tested have the potential to provide additional insight beyond random choice. But we do not currently predict the actual value for the price changes using regression. Just as a reminder that we are looking primarily at the trend as a classification task, and we're indicating whether or not there is an increase or a decrease in that price. So this information can help investors formulate their investment decisions, but we do not currently provide an investment strategy or try and predict the specific price changes on a day-to-day basis because the possible investment strategies are varied, and there's a lot more information that needs to go into informing these sorts of decisions. So some challenges that we need to overcome and that present some possibility for future work are that these prices are definitely affected by other factors beyond the sentiment analysis that we were able to collect and the day-to-day price data. The stock market volatility is also a factor. Changes in interest rates influenced by large organizations and other economic factors aren't incorporated into the proposed models, and incorporation of these additional features may help to improve the models in the future. This is a very difficult problem to solve due to the volatility and speculative nature of the cryptocurrency market. And in addition, area that we could improve the model in the future is that we could step away from general sentiment analysis surrounding all cryptocurrencies and focus on specific cryptocurrencies during the sentiment analysis portion to get a better view into how sentiment is changing on those individual currencies. So subject to your questions, thank you for listening to our presentation. This concludes our presentation. Thank you.
Thank you.